The market finished off a really strong week with a little bit of an exhale, and could that could we get more of that heading into next week? So I'm going to break down this great this great rally we've had this week, especially in the Russell 2000, and what that means for this new intermediate trend that's developing and getting going here. But also what we can expect to see heading into the FOMC from a technical perspective, and the decision that they have coming up, and the different factors that may influence that decision, and how the markets may respond to that. We'll take a look at this rotation that we had this week to see if that's the kind of rotation that we want to see starting a bullish run, and then we'll talk about how we can trade a stock that had such a big, strong rally here those past couple of weeks without necessarily chasing it. So let's go ahead and get started. Today is Friday, September the 13th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and get started here and take a look at the S&P 500 with the market forecast indicator, as we always do. You can see we got the bullish combination here of the dark green shading and the rising green line now. Now, in the past, when that's occurred after multiple days of having the dark green shading with the yellow line, we typically get a near-term pullback that comes after that pattern develops. So that's in this. It looks like in this case it was back here. If I were to zoom out a little bit more, so there's the previous intermediate run and how it started. And then over here, you can see you got the green line, then you got this near-term pullback. It basically, after an extended near-term rally that gets you started on the intermediate run, you kind of run out of gas, and then we get going again. Same thing here. You got this big near-term rally, gets it going. In fact, you can kind of call this one big near-term rally. Brief pause here, gets the intermediate line in the reversal zone, then you have the near-term pullback. A little deeper than this other one. But the premise is still the same, that it takes quite the rally to get to this point, and we've had quite the rally to get to this point, and now the idea is, there's just a little bit of an exhale before we take off and continue, because again, this is a bullish rally, and the market sentiment's still falling, but to have the green line rising, to have the dark green shading, that's what you like to see from a market forecast perspective. The lines drawn here, so remember this intermediate rally we had here, the blue dotted line is the bigger Fibonacci retracement zone between 23 and 78%, the smaller ones here in orange. We've since broken out of that blue line here, but keep in mind that can still act as a support level on any kind of near-term pullback, a pullback that brings only the blue line down below 50. And as that does, you can notice that I've got these Fibonacci lines drawn too. If I zoom in a little bit closer, let me see if I can zoom in any better. There we go. I've got these lines drawn that, again, the 38% Fibonacci retracement of this near-term rally essentially lines right up with that 23% Fibonacci retracement. So we're looking at about 2950, 2954. That appears to be, if we do get any kind of exhale, about where we would come down to in this upcoming week. Keep in mind that that can impact, or that could be largely driven by interest rate cut expectations, and that cut. Sorry, I need to pop up here. And that cut, those expectations are starting to actually drop. The odds of not getting a rate cut are up to about 20% now for this next month. The nice thing about this current rally is it's not just the S&P 500, but it's also, you can see the Russell 2000 has joined in. So, because of the strong week that it's had, in the last couple of days it's been a little bit lighter, and you can see the relatively long upper shadow that again might be signaling that's, again, set up for an exhale. It doesn't mean that we're going to necessarily roll over, but just a little bit of an exhale to catch back down a little bit to some of these moving averages that we've pulled so far away from. But that catch up in 3 days got us to the point. See, the S&P 500 broke out right there, and the Russell didn't. It was still sitting right at its downward trending moving average. The fact that it caught up in the first 3 days of this week gave it the same pattern, dark green shading green line at the same time as the S&P. And you kind of need that. You need that, the Russell, to at least develop that same pattern at the same time as the S&P, if not earlier, is what you prefer. So if we didn't have the Russell participating so much this week, then we'd be a little concerned. We'd be concerned that this intermediate rally on the S&P might have a little hitch in its giddy up to get it going. But now that the Russell has kind of confirmed it, the expectations are right there, barring just a near-term exhale here early next week. Again, just to bring the blue line back below 50, and that's it. You can see it already has been on the Russell 2000, but on the S&P 500, it's been what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days as it is. We're going on 13, 14 days heading into next week, depending upon how fast it falls. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, that you liked the video today, that you got something out of it. Number two, that you want us to do it again Monday. So it's a quick way to give us feedback. It's the feedback we look at to see what you're thinking day in and day out. So click that down there. You can do that right now while you're watching. Again, if that's the case, if you want us to do the video Monday, let us know with that thumbs up down there. Also, while you're down there, click comment. What did you get out of today's video? Was there anything in specifically that stood out to you? Let us know as well. Join our daily market outlook email list. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day, and join our market outlook community that we've created on Facebook. And again, on the blog here, if you're watching our video on the blog, check out today's Market Outlook live video where we put on today's trade idea before the market closed. We also reviewed some of the previous trades that we're currently in and talked about those in terms of their management going forward. You see that a lot, right? People on these TV shows always talk about trades that they're looking at, but then they don't continue to talk about the trades after that, or even when they get out of those trades going forward. So that's what the purpose of this video is, to follow up on all the trades that we talk about in the market outlooks from day to day. And again, to get access to that, you have to have our Plus subscription. You can get access to that here with this link right above the video. Start your 30-day free trial and check out our other classes. The two classes that come with that subscription level is our technical analysis class on Fridays, and which I just did, and then our Tuesday dividend growth investing class that Brandon teaches. So that's how you can get that live market outlook. We also invite you to engage with us on social media. Here's our today's market outlook tweet and Facebook post. Very easy to make. We make it very easy for you to engage with us. That way, you're letting Twitter and Facebook know that you want to see our content. You can do that by clicking on this heart. Then hit that like button right here. Great to see that we got back up 100 again. And then here, just click on this image. It will take you to the Facebook post, and you can like it from there. All right, so on the long-term chart, the S&P followed through last week with last week's candle. Had that little concern of that long upper shadow on the Hakinyashi here. It followed that up with without having another transition candle, and that was the concern going into the month. That we would retrace August range, the lower end of its range here at the beginning of September, and with that long upper shadow here, as early as this week doing that, but we didn't. We broke out. We closed the Hakinyashi candle up above last week's candle, so very, very bullish follow through. And a good sign for the market going forward. And you can say, okay, well, then how bullish are we? It's not like we're starting a new run. But remember, when you get the golden crosses, they can last a while here. We just barely got one at the beginning of this year. And also, if you look at my chart, and if I were to go back, let's give us some context here. Where we're at right now, and you look back on this chart, and you can see the market has spent a lot of time with stronger momentum than we currently have right now. So it's not like we're even overly overbought in the least bit at all on the long-term basis either. So lots of potential for upside movement here. Obviously, looking at the three green arrows, here's the issue, right? You have three green arrows. We are starting to drop in momentum. You see these gray bar is showing up, that means the MACD is falling and we're losing some momentum. The question is, when are we going to gain it, and why are we losing some of that momentum? Well, it's because we're so far up above the 8-day moving average. If I were to throw on and take a look at the MACD and look at where we're at right now relative to that 8-day moving average here, you can see that this level here, what did they get to? It got up to 50.84, and this is on an absolute basis, mind you. It's not a relative number, so you can't really compare it too far back in time. But you just can kind of get an idea that this is we got as far back up here and we paused and we pulled back to the same thing right here, and we pulled back to the 8-day moving average. We had this big rally initially. We pulled back to the 8-day moving average, pulled back to the 8-day moving average. And a lot of times the pullback to the 8-day moving average doesn't necessarily mean that we have to break through. You can see how when you get this intermediate run started, we'll be above the 8-day moving average for most of the time. A couple of times it'll come down. That produces the weak bearish postures. You can see over here too, briefly got down on that pullback, and then again right here, but nothing major. Right, so now that we're starting this rally, again, the expectation is we'll probably, and you can see we're pulling below the moving average here. We'll most likely pull back towards the zero level. That may mean that we just stay sideways and the 8-day moving average runs up to catch up. And that's simply all that there could be there. And it might dip its toe a little bit below zero, but more than likely we'll probably just come down towards it. And then stop its decline there, and then we can really get, then we can get going again on a new near-term rally on the market forecast that would last 7 to 12 days. Looking at all right, if you look at the intraday chart for the S&P, there's our rally. There's the gap open on Thursday, and then we kind of Thursday, Friday, Monday, and even the beginning of Tuesday, we rallied. But remember, crude oil peaked early Tuesday morning, and then it dropped. And from the drop in crude oil going forward, stocks rallied and up until yesterday afternoon when it peaked. And then, of course, just simply an exhale. And again, this is pretty much all the exhale is going to be. 296 would be down. If we were to pull back down into this area, and we're more than likely now not going to fill in that gap anymore. So probably coming down towards this 267. At the worst case scenario, the low of this week, more than likely into this 298 area at all this upcoming week. So you can see that would not be that big of a pullback as well. And like I said, worst case scenario down towards this 296 level into the part of the gap that we have filled in, and that's it. And there's where the next kind of small layer of volume support is going to be. Obviously, looking at looking at today's range, very, very small range, 14 points. If you look at SPY, it was 1.5 points. Obviously, no gap there, and then the volume at 62 million down there. So we'll take a look at that put that in context. 1.5 points is way down here at the bottom. 62 million is a little bit below average, but that average is getting lower and lower, and now we're really close to crossing below the 1% mark again, which is when that intermediate trend gets established, and we can stay down there for a while. We just start grinding our way higher at that point. And again, 1% up here is different than 1% over here, right? 1% over here, we're at 250, 25 points, or 2.5 points. 1% up here is 3 points, so it's a little bit different. But the 1% mark, trading, consistently getting ranges below 1%, which we have been for the last little bit, under 3 points. That's bullish. That's a very good bullish sign for the markets, and we just grind our way higher. The volatility index really broke down this week. If I look at it on like a weekly chart, you can see we didn't close below 15, even though we did close below 90% last week. We didn't close below 15, and that's uncommon for that pattern to develop. Well, that rectified itself this week. We did close below 15, obviously a smaller range, but that's not surprising. And you can see that we are closing into the lower half of the range. Of this bullish range. The bullish range, is midpoint is a blue line. So the top end of the bullish range is 90%. The lower end, the extreme end, is 80%. So we're getting into the lower half, which like that 1% mark on the 1% mark on the ATR means that we are now established on this bullish trend and going forward from here. All right, so to summarize the technical outlook before we start looking at what's driving the action here this week and what to look forward to next week, as well as our trade idea for today, the trend is bullish. The intermediate run is starting. There's a lot of good signs going forward that we can expect that this run will last for the expected 1 to 3 month time frame, if not even longer, due to seasonality, multiple seasonality factors heading into next week. So, but it's the train has left the station. That doesn't mean that we might not pause a little bit here next week. If you're trying to chase that train down because you didn't get on at the station, give it a second. It will slow down a little bit. It's got a little hill. It's got to get up first. That will slow it down before it gets going again to full speed, probably by the end of next week after the FOMC meeting, if the FOMC doesn't clearly knock it off the rails, right? Knock it off the track. So that's kind of what we're seeing here. What do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe or to vote. Excuse me. You can tell I say the same things over and over too much. If you click, you can hit either agree or disagree. If you click disagree, comment down below on what you see that is different, or what maybe you're not as bullish. Maybe you are more bearish than I am. Let us know down there in the comment section below. All right, now let's take a look at what's driving the price action today. And first, let's take a look at the economic calendar. You can see that the big announcement today, at least, was the retail sales figure. Let's take I wanted to chart. They don't show you on Intraday calendar anymore, the actual chart. But this is the year-over-year retail sales number. And you can see it's growing at a 4.5% clip year-over-year. When you take a look at, remember a lot of these economic indicators peaked and started to come down right about August of last year. I mentioned that a lot of different times over this period, and the year-over-year figures have been dropping. But you notice retail sales bottomed out in December, and since December, with a few little hiccups along the way, we've gone from a 1% year-over-year clip back up to a 4.5% clip. Now, keep in mind we were running at a 5% plus clip at the peak in 2018 before the wheels kind of came off a little bit, and we had the rate cut here in December, or at least the last rate hike in December that the market kind of struggled with, and that was the environment that we were in going into that. So with that being the case, things are really improving, and again, from an economic surprise index, we're above 17 now. We were way in the negative 60s here just about a month or two ago, and now we're up to 17. Big change here for the economic surprise index, and we're also positive now from a global standpoint as well. All that's done here is increase the odds that we might not even get a rate cut here in September. Now, it's still 80%, and that's still a very high probability. The market still priced it in, but we're just sitting right at 80%. Once you get below 80%, now it's a high probability, but it's not necessarily priced in. The odds of not getting a cut just continue to move up pretty sharply here. A week ago it was only 10%. A month ago it was 0. We had a 4% chance we get a 50 basis point cut. In fact, if you look at the 50 basis point cut, the odds in the historical chart here, that would be the this dark blue line. You can see we were up at one point in time right here. It was up to almost 40% odds that we'd get a second rate cut. That was in July, middle of July. And even at the beginning of August, it was, right around 25%. Now it's 0. And now the odds here are continuing. In fact, that light blue line here is actually bumped up today up to 20%, and this has come down to 80, just like that. So, things are changing a little bit. In fact, if you look at December, we have, a 7% chance now. We don't even get a rate cut by the end of the year. That's reflected in, what we're seeing here in the September contract. But then going out to a second rate cut by the end of the year, which was pretty much priced in. Right? I mean, we had about an 83% chance of a second rate cut by the end of the year just a week ago, practically. And now we're getting, what is that, a 56% chance of, 44 there, about 45. So about a 55% chance we're going to get a rate cut. And that's not even, that's essentially just a little bit more than a coin flip. So, I mean, it's not that we might be one and done. And if that's what the Fed starts to put out there, that might be, we'll have to see how the market takes that, because the market has been pricing in, for a long time here, multiple rate cuts going into the end of the year. In fact, we had pretty decent odds, just again, like a month ago, we had pretty decent odds that we would get, 94% chance of 2 cuts, 100% chance of 1, and about a 70% chance of a third one. And just 1 week ago, we had an 80% chance of a third cut by next April. 80% chance. The odds now of getting a third rate cut, and I'll have to do this here on the calculator because it's frying my brain doing the math in my head. But now you're looking at a 42% chance. We've gone from an 80% chance to a 42% chance of getting a third rate cut by next April. So, in fact, I mean, it's not even an 80% chance we get a second one by next April. The market's really starting to take out the odds of a rate cut, which is interesting because when you look at the 5-year forward here, oops, excuse me, let's go back to, yeah, we got it right there. Try that again. 5-year forward inflation expectation rate, and zoom in here. And again, let's take a look at it weekly ending on Friday. And then we'll go back, like 5 years here. So here's the week heading into this week. So this week is what's happened in inflation. Now, we've had, at the beginning of July, from July, the week of July 5th, ending on July 5th. Well, this would be the week. Yeah, ending on the 13th. So this would be the week ending July 5th, all the way up to the week ending July 26th. We had a pretty decent run in inflation expectations there. And, if you take a look at, go back and look at the odds, what is it, right? Let's go back to September, and we'll go back to historical here. And that kind of first few weeks in July, you can see the odds of not getting a cut were relatively high, at that point. The odds of getting at least one rate cut, though, stayed at 60%. That whole time the odds rallied that much, right? Well, the inflation expectations haven't rallied nearly that much. It's just 1 week, and that's, in fact, I mentioned here before that the inflation expectations now are worse than they were in June of 2017. The inflation expectations now are lower than they were here at the beginning of the year when the market was really tanking to the downside. There's a sharp discrepancy. I think I brought this up to you before, but here's the inflation expectations in purple, and then this is the S&P 500, and you can see, the S&P has taken off from this June low point, end of May low point, but you can see that the inflation expectations haven't. In fact, they're still lower, and like I said, they made a little bit of a jump here at the end of the week, but they're still right around this area. So the market's kind of taken off without inflation, and that's why there's still an 80% chance that we'll get a rate cut in September, even though we are sitting at all-time highs, because we haven't seen the same. I mean, there's that beginning of July inflation expectation jump that basically lagged behind the S&P taking off that rally here. we're still even though we're pretty much getting close to new all-time highs, we're still way far behind in inflation. And that's a problem. And that's what the Fed's trying to rectify itself and try to close that gap right there. Ideally with not bringing this down, but bringing this up to catch up to it. If you take a look here, oops, sorry about that. There we go. If we take a look at how the market's been performing here this week, and really, again, it actually goes back to the breakout on Thursday. Here's that peak on crude oil on Tuesday morning. The S&P wasn't even up 1%. The small cap index was up at the time 3% from the breakout from last Wednesday's close, the breakout there. And so you can see from that point, crude oil's really dropped off to the downside, but not necessarily the case for small caps. They've really jumped up to the upside, doubling that gain from 3% to 6%. Right here, we've gone from just under 1 to just over 2. So pretty decent moves in equities. But you can see gold dropped a little bit. Long-term bonds, they're down 7% since the breakout. Gold down 4%. So we're getting a pretty sharp unwind, a risk unwind, or safety trade unwind, back into risk, right? And that's why you see the small cap stocks doing so well. Large cap stocks didn't really drop. They actually held up pretty well during that safety trade, that overbought safety trade. Well, now the money is coming back into the Russell had been underperforming for so long. Money's coming back into that area, and the Russell's outperforming now in a big way. That's a good thing for risk appetite. You want small caps to lead the way higher. You don't want safety trade to lead the way higher in a bullish market. If I go back from the June low point, so from that May 31st when we had those oversold levels, we bounced off of that. You can see initially you had oil and stocks, large cap stocks in particular. Small caps really were lagging behind. Gold being up as strong as they were. Bonds weren't falling; they were holding their ground pretty steady. And then when the S&P fell a little bit. Then they took off, and then as the S&P continued to come off of its lows, the safety trade held. So off of that June low point, when the S&P was up over 6% coming off these lows, gold was up, 19%? The long-term bonds were up almost 12%. Off of a date where the S&P was coming off of some pretty big lows, and the Russell 2000 at the same time, again, that you had about a 6% return on large caps. The Russell 2000 was practically negative. So that's unwinding in a big way, and you're starting to see a move back into those riskier asset classes, except for crude oil. So another sign that we might get some short-term weakness here if the market follows what we see happening in crude oil. If you take a look at the long-term chart for crude, you can see it's been trying to get going here, but again, can't quite get back up above its 200-day moving average. This is what its Hakinyashii candle looks like, or the regular candle looks like. We got up to the 200, we held for resistance. We're still kind of in this death cross environment. We're back below a falling 50-day moving average. When you look at it on the market forecast standpoint, we're back to a weak bearish. We have a red line, but we have a weak bearish posture again with the intermediate line falling. So we can't be bullish and risk appetite unless crude oil comes up along with it. It is lagging, so it doesn't have to come up now, but eventually you'd like to see that correlation take hold again. You can see the 10-year note looking a lot better. Big time move to the upside in yields coming off last week's engulfing pattern that we saw in yields. And of course the dollar index breaking back down below 98 today. So after it looks like we were bouncing back up here a couple of days ago, a big reversal yesterday, intraday, and then following through with that today with a big move to the downside. Interestingly enough, the European Central Bank, which was issued their statement, their monetary policy decision here this week, was relatively dovish, not as dovish as the market expected. And you can see the euro's kind of taken off on that move yesterday and continuing with that move today. This has been a bigger factor in the dollar's move than anything lately. In fact, if you look at the weekly market forecast, it's still got some room to go. So the dollar's not tanking right now, but you can see how we've had a little bit of improvement, short-term improvement in the euro coming after that meeting. Here's how the sectors performed this week, and interestingly enough, at the beginning of the week, energy really took off, and of course, the weakness in crude from Tuesday morning on limited its gains the rest of the week, and it was ended up being down. But you can see energy and industrials and financials, which have also been two of the other three losers from a sector rotation standpoint, they finished the week really strong. Energy finished strong too. Materials rallied on that dollar weakness, so you can see materials really took off again. But though you can see that you have communication services kind of matched what the market's doing, but discretionary. Look at technology coming down here at the bottom. It was actually doing pretty well, but it really came down here at the bottom. You can see that staple real estate had a bad week, down 3%. Utilities was lagging the market, but flat on the week after they kind of rallied here off of their lows. At least utilities and staples did, but not really the most bullish sign to see. Your more cyclical areas, technology, discretionary, lag behind the S&P on a really good bullish week. It's good to see energy, materials, industrials, financials. I mean, those are your big losers, but bull markets aren't led by losers to the upside. Bull markets are led by your typical winners, and so again, I think at some point in time we'll get a little pause to get your typical more cyclical areas leading the way higher again, just like they normally do. All right, so for our trade idea of the day, one of those industrial companies that really has taken off is Cummins. You can see Cummins, excuse me. You can see it's got that bullish pattern, strong bullish posture, green line. You can see, it's across the board. You've got three green arrows. Let's pull up the chart here. You got three green arrows, rising moving average, even though you are starting to lose some momentum here. You look at the long-term chart for this stock, and you can see, it's turning up. Its PPO is turning up. This is the basically the crossover of this 1040 weekly moving average. Excuse me. So very bullish reversal here. Very good sign for the stock in terms of the potential long-term rally to come out of this. Even though you can see a not so good sign is the last golden cross did not get you up to new highs. So it's at least this death cross didn't last very long, and basically you might have the potential to run up to new highs here on the current golden cross move. But in the short term, we are way far away from its 8-day moving average. In the 8-day, you can see it's way far away from its 17-day here. So that's not, that's pretty bullish, and it's hard to chase that when you're looking for bullish trades. You expect, especially when you got a high up here and a low down here. So a lot of times when you see a stock that has a relatively high bandwidth, you can see how big the bandwidth is to the upside. See, all these other times were bigger, but they were all on downside moves, which tend to be bigger anyway. This is a pretty big move to the upside, especially when you got a lot of volume both above us and below us. A lot of times it can stall a little bit for a while. In fact, the Market Outlook Live video showed some prior examples where when it got this bullish in such a short amount of time, using its rate of change indicator, it stalls here. So what do we trade when we stall? We can do both a call vertical on the upside and a put vertical on the downside. So if you look at what we can set it up with, a 155 put and buy the 150 for protection, sell the 175 call, buy the 180 for protection. You analyze this trade. Over here, let's take off one that we currently have put in here. So there's our break even. So pretty decent odds of success here, and then you put those break evens on the chart. And then you can see that's what these blue lines are. So we've got room to the upside to work with before we get to break even. We got room to the downside to work with before we get to the break even down there as well. And the idea is, considering how strong the trend is here, or how strong at least the short-term trend is, there's an expectation that look at the green, the orange line has just barely dropped below 20. That's how bearish we were and how quickly we switched from being very bearish to very bullish. The fact that the orange line is just barely dropped below 20. So again, the expectation on this trade is that we will kind of grind for a while and let some of this, especially with earnings coming after October expiration, kind of let some of this unwind a little bit before we get going again back to the upside. All right, well, that wraps us up for today. You've heard from me now, and now I want to hear from you. Let's keep this conversation going by going to our Market Outlook forums on marketscholars.com. Open up any new thread with any questions or comments you have about today's video. If there's anything we didn't cover in today's video that pertains to this topic, of course, open up a new thread there and share as well. And then reply to others' threads, and let's, like I said, keep this conversation going in between videos over the weekend here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between the videos, and join our Market Outlook community. We're about 1,600 strong now on marketscholars.com, as well as our community we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all on Monday.